Everybody, this is David True. Those of you who've attended our events before will know me, but those of you who haven't, I'm the president of NIPE, which has been around for God over 15 years now, running events such as these. And so, for those of you who haven't attended the event, one of our events before, it'll be. I hope you enjoy it. And for those of you who have, welcome back. Um, I wanted to thank our sponsors, Davis Wright Tremaine and Further Advisory. Without them, this wouldn't have happened. Um, and some housekeeping items for tonight's event. If you have questions, please use the chat to log in and pose your questions. There will be a Q&A at the end of the discussion. And then, as you probably know, there will be a couple of breakout rooms of 10 to 12-minute duration at the end of the panel discussion for you to talk at a more smaller group to network with folks who've been on this event tonight. So another housekeeping item I'd like to ask is if you're not one of the presenters or on the panel, please turn off your camera and microphone, and you can swip those back on later on once we get into the breakout rooms. And so with that, I will turn this over to Mary Wisniewski, who will be moderating this wonderful panel tonight. And enjoy, guys, and feel free to question at will. Okay? Bye-bye.
Thanks so much. Yeah. Hi, everyone. Questions at will. Let me definitely encourage that. We want your questions at any given time, and I'll be watching out for them to help answer them as they come up. But a little bit about me. I'm an editor at large for Cornerstone Advisors and a longtime fintech reporter. I used to cover the beat for American Banker and Bankrate and a bunch of other pubs. So that's a little bit about me. And I think we'll just do quick introductions to begin with. And I'm going to kick it over to Brian, who has informed me this is the highlight of his day. So Brian, give us that energy that says this is goodness.
Thank you very much, Mary. Great to be here tonight with everybody. By way of quick background, I run the corporate venture capital arm of TrueStage. And TrueStage is a large insurance and financial services company. And what's unique about TrueStage, our parent company, is that we work with about 6,000 banks and credit unions, providing a broad range of insurance, financial services, and more recently, technology solutions. So we've invested in about 55 fintech companies. I also head up our acquisition strategy, and we've also acquired about 7 fintechs over the last 5 or 6 years. So that's a bit about my background.
Wonderful. And now we'll kick it to you, Dan.
Thanks, Mary. I'm Dan Axelson. I'm a managing director at Catalyst Partners. We're a M&A focused investment bank in San Francisco. We advise companies on strategic M&A. I lead our fintech practice here. If you're not familiar with our firm, or if you haven't worked with us in the past, we're known for advising on deals like Afterpay's sale to Block. We advised MailChimp on their sale to Intuit. We advised Coupa on their sale to Thoma Bravo and quite a few others. So thanks, Mary. Thanks, NIPE, for doing this. It's great to be on with all of you.
Thanks for being here. And Adam.
Hi, my name's Adam Hallquist. I'm a principal investment team at FTV Capital. We're a growth equity firm with offices in San Francisco, where I sit, as well as New York and London. We've raised 7 funds in our history and are currently investing out of our 7th fund that's $2.35 billion. We've invested in payments companies like Card Connect, which was sold to First Data, a company called Finaro, formerly called Credirax, recently sold to Shift4, and then still investors in a company called Explore, formerly known as Clearant.
Great. So now everyone knows that we have people here who have a great perspective on what might be an interesting investment looking out into the year and what maybe wasn't so great in the years before. But I thought we'd begin with setting the stage a little bit. 2023, I think to say it was challenging is a generous way to characterize the year. And I'm curious, now we're into 2024. It does seem like it's shaping up to be a volatile year as well. But I'm wondering, I want each panelist to weigh in on this one. And it's just has your investment approach changed from the hype years? And if so, how? And I want everyone to weigh in. So whoever's feeling bullish about weighing in first, jump on in. perhaps it's Brian again.
Sure, happy to jump in. I mean, I think what we've seen and kind of how our strategy has shifted, a bit is, one, we've seen a lot of investors really look to invest in companies that are in their portfolio. So a lot of insider rounds to kind of help sustain companies, through what has been, a pretty challenging 18-month plus window now for raising capital. So, that's been one kind of, protect your own, if you will. I also think, talking to a lot of funds, ourselves included, I think going a little bit earlier stage, versus, not investing in some of the late stage companies that raised large rounds back in 2020 and 2021. So kind of looking for, some of those earlier stage companies seems to be a common theme. I guess I'm more the optimist, so when I kind of look ahead to 2024, I'm hoping that, we're kind of have, maybe some of the darker days behind us. It still will be volatile, but, we certainly are now this year turning our attention to new companies that we can bring into our portfolio.
I'm happy to hop in next. I'd agree with a lot of what Brian said. I'd say 2023 was challenging from the interest rate environment, which led to a lot of uncertainty on both the investor and entrepreneur side. And coming off of, high market multiples that happened in 21, I think a lot of entrepreneur expectations of where multiples were still quite high. Investors, more pessimistic. I think both of them were wrong to a certain extent. A lot of investors were overly pessimistic when you look at how the overall economy performed. And then I think entrepreneurs have come to realize that maybe those 21 multiples were once in a decade, and therefore, you need to plan for a more regular multiple environment going forward. And I think we've come a lot closer. If I look at the types of companies, I mean, it's popular to say, but true, people are less focused on the burn at all costs. And if you look at the public market multiples, there is just more value being ascribed to companies that can grow and do it profitably or break even, or where the unit economics really makes sense. And there's a lot more scrutiny on those by investors. I'd say if you look forward to 2024, listen, I have a small peer review of what our firm is seeing, but in our Q1/first 4 months outlook, I think we will do as much in new investments and on sales of companies as we did in all of 2023. And I think part of that's just, the rate environment's either stable to down, which just makes it easier on all levels for capital to be freed up and for deals to start moving again. So I'm very optimistic that 24 is going to be up from what we saw in 2023.
And I can just add a few notes from the M&A perspective, what we're seeing in the M&A markets, because in some ways, a purchase of an entire company is the most high conviction investment you can make. A lot of it is the same. I would agree with Adam. It feels like we've maybe swung too far in the pessimistic direction. If you look historically over the last couple of decades, when we've seen IPO markets trough like this, when we've seen M&A markets fall off a cliff like they did in even 2022 and then into 2023, those have often marked the beginning of a new bull cycle. It might take a little while, but these have been some of the greatest times to invest. These have been some of the greatest times to be bold and to find opportunities. Now, it's tough. It's tough, but if you have conviction in what you're looking at, if you can separate the wheat from the chaff, and that is what we see a lot of the best strategic acquirers doing, is looking at these investments with a lot of scrutiny, doing a lot of diligence, erring on the side of safer types of companies that look more like software companies, usually looking a little bit less like lending companies or even into the crypto markets. But we are seeing companies just start to think about what could be the bold move right now. Obviously, we saw the Capital One Discover news today. I think that's one of those moves, and I think we're going to see more to come.
Yeah, let's talk about that a little bit. I mean, so you see that as a signal as, oh, this is what's to come in the months to come.
I don't know that I would call for more deals specifically like that to come, but I think the companies that are looking to use this as an opportunity are going to be glad that they did so, and they are going to see opportunities which may have not been quite as timely in a year like 2021.
Right, right.
One thing, Daniel, you might have a better view in that I think is interesting about things like the Discover Capital One deal is there was a lot of fear of antitrust that seems to be, misplaced, as a lot of those cases that have come up, Justice Department's been unsuccessful. And so it seems like maybe that will make people bolder going into this year versus, the fear that they had of that, in the past.
Yeah, that's been one of the toughest things in M&A markets. It's just that there's a huge amount of scrutiny with the current administration. A lot of it is general, almost fear or general antagonism towards big tech and what that's often being expressed through scrutiny of M&A deals. And yeah, not all of those challenges have worked out. Some of them all surprisingly have. But it's had a chilling effect on M&A, and that's been bad in my view, of course, for the entire community. It means fewer exits for entrepreneurs. It means fewer exits for investors, and I do hope that that'll turn around too. It kind of feels like it can't stay as challenging as it has been in the last couple of years.
Brian, I want to kick it to you because we had a pre-call and you're very focused on the credit union market, and you said something very intriguing to me that you thought from a regulatory standpoint, it was a little bit easier than from a banking regulatory standpoint. And let's walk through that a little bit.
Yeah, it's been really interesting. The credit unions are regulated by the NCUA, and at least over the last 3 or 4 years, the NCUA took a fairly favorable approach to credit unions collaborating and partnering with fintech companies. And I think they view fintech companies as being a critical component of credit unions being able to kind of adapt and modernize and stay relevant and I think financially secure. So they have been surprisingly supportive of these types of partnerships, creating some white papers and different guidance that I think has allowed at least the credit unions to get more comfortable around some of the fintech partnerships out there. There's some changes that are occurring within the composition of the NCUA leadership. So I think we'll kind of see whether there's a different maybe position that comes out, but at least over the last few years, especially compared to what we see on the other side of banking regulation, very different approaches between the two.
And what are you seeing the attention? We had this pre-call and you had mentioned like it's kind of a newer thing that credit unions are, investing in general, or it's picking up in the last couple of years. So, what are you seeing from your side of thing, and where is what are they focused on in terms of opportunities?
Yeah, so over the last 3 or 4 years, we've seen increasing numbers of credit unions either invest through a venture fund or make direct investments into fintech companies. There are a couple of states that have relaxed the rules around credit union investment. And so, I think they're really kind of viewing these fintech investments as a way to help drive innovation into their credit unions. They've been very proactive with companies that they've invested in. And typically it stems out of a partnership or relationship that leads then to a subsequent investment. But we work with a number of credit union CEOs that have started to ask for deal flow and kind of want to get more proactively involved. And so I think probably what happened too is a lot of credit unions, and I'm sure bank executives of the world saw the valuations on fintech companies go through the roof, during that time period. And I think people thought you can make a lot of money without a lot of effort or work or expertise. And I caution credit unions. It's a different world. Kind of align yourself with people that really know the space. So I think that's just sort of the lay of land of what we're seeing.
It's really funny. Make a lot of money not knowing much. I know that's a sentiment that enters people's brains from time to time. But Adam and Dan, I know you have a different perspective. You know, what are the opportunities you're seeing this year that maybe have changed from last year, or just broad categories, really?
Adam, do you want to jump
Yeah,
in?
yeah, I'm happy to jump in. I think this year, so there's a couple different areas within payments that we think are really interesting. One is account to account based payments, and we're starting to see that evolve a little bit out of more high risk categories like gambling or personal loans and into other more mainstream areas. A lot of that is outside the US. So in Australia, for example, it's going into travel. And so we think there's some interesting things to be done there. We continue to see a lot of opportunity in vertical software and payments. And as vertical software companies look to go multi-product, payments end up being a nice extension because the customers are less price sensitive, and then they end up being stickier as they're using multiple products there. So those areas are interesting. You know, there's areas where we haven't invested and we're still watching to see how the market environment evolves in like the buy now, pay later and more, you know, lending elemented businesses, which we saw through as a couple of our companies that are suppliers to that industry. You know, there was a bit of a shakeout last year, so it'll be interesting to see. I think some of the stronger businesses maintained and they'll be able to take some market share. And then, you know, we continue to not spend a lot of time in the crypto space. You know, we watch it closely, but I'd say because we're growth investors, businesses haven't quite reached the right stage or opportunity for us to make investments. And some of the most successful ones have really gone venture and then shot past us. So that's another space where we watch it, but we're probably unlikely to make an investment.
Yeah, and I would agree with all of that. The longer term secular drivers that we're guiding our clients towards and that we're seeing in the market are still the increasing digitization of everything, including payments and bill pay, core consumer financial services. And so what we see a lot of is that a lot of these categories that have existed for a long time. I mean, there's only so many financial services you can sell to people. It tends to come back to lending, it comes back to payments, it comes back to investing and a few other things. But the opportunity to produce these things in a new, more streamlined form factor, something that is more delivered in a software package, that still exists. And even categories where we think we've seen winners continue, there still is a huge amount of startup and company formation activity. So I come back to bill pay, I come back to investing and retirement planning as categories where there are challenges and these categories haven't been solved. They tend to be complex, they tend to be cumbersome. Anyone that can improve on these processes will find vast markets that are still largely owned by incumbents. They're challenging markets to crack, but they're areas where there's a huge amount of opportunity if you can find a good way to do it.
Let's drill into that a little bit. What's one example of a challenge that you think really needs to be solved for, but hasn't been solved for yet?
You know, I just mentioned investing in retirement planning. This is still very difficult. It's difficult because every human is completely unique. I do think that the robo-advisors have done very interesting things, and those companies, after more than a decade of building, are doing extremely well, actually. But they still haven't solved this challenge of how to produce advice and retirement goals at scale. It's a very difficult thing. Every person is different. They've got different family situations, and everything stems from that. And so as much as there's a huge market out there, it still hasn't been one where someone has found a really great way of delivering a platform that can capture a lot of the value.
And Adam, I wanted to go back into, you mentioned buy now, pay later. You know, what do you think are like good traits, quote unquote, good traits in a successful buy now, pay later provider?
Yeah, I mean, I think a lot of it is on credit underwriting and being able to somehow score the consumers. We've looked at it in the past, things that have used things like social, for example, and you find out that once you get beyond a certain number of factors in a model, adding another one or two, like how many tweets they have, is not that effective in figuring it out. But being able to really study different vintages and therefore being able to underwrite consumers and staying very stringent on those specific requirements to underwrite loans, I think is important. I think also developing, top tier partnerships so that you can get access to, the workflow in a better way, where you're part of the checkout experience, but you also have a real close relationship with the company that's ultimately selling the product in a way that allows your, effectively loans to be more successful. I think probably the last piece is looking at some element of flexibility and being able to modify those terms, which I think is pretty difficult for some of these loans, but being able to convert them in different ways that allows you to extend the time horizon, still monetize them in a successful way, but essentially make it so that each vintage you have can drive greater returns. Those are probably the elements I would look at.
Okay, cool. And Brian, is that an area of focus for, credit unions?
Yeah, it certainly is. I mean, we've invested in a number of companies that are in the lending technology space, including the BNPL space. I mean, in terms of, because we are a strategic venture fund, we get a lot of feedback from the banks and credit unions we serve. And again, kind of going back 2 or 3 years, we could not provide enough loans to the balance sheets of banks and credit unions that were partnering with some of our portfolio companies when the banking system was really flush with liquidity. Kind of fast forward to 2023, no one wanted to talk about lending tech. It was all about what solutions are out there that can help grow the deposits on my balance sheet. And that's an area that's much more challenging. There are not a lot of companies in the fintech space that have developed solutions to kind of meaningfully help depository institution grow their deposits. So we've focused a lot on that. I think in the rising interest rate environment, it also has created compression around profitability. So we're seeing a lot of executives now asking for solutions that will help drive automation and therefore reduce costs for their organizations. Or alternatively, what other opportunities are there to partner with a fintech company to generate new sources of non-interest income? And so, as we've seen a lot of pressure around, eliminating some of the banking fees, that puts pressure on these financial institutions, especially some of the mid-sized to smaller institutions, to determine how they're going to replace, a source of revenue that they've either voluntarily relinquished or have been kind of pressured to relinquish. So again, seeing a lot of interest that probably didn't exist 24 months ago to kind of leverage the trust and customer relationships that these financial institutions have built, but partnering with fintech companies that have new, innovative, and really good experiences that they can deliver into the customer base.
Yeah, you sort of opened the door to AI and banking as a service with those remarks, but I think probably all of those are universal for the panelists. But let's start with, before we get into AI, let's get into banking as a service or embeddable finance. And I know a lot of institutions have looked at that as a revenue source, potential revenue source. And on the other hand, there was a lot of regulatory issues that came up last year in particular. And I'm curious, how everyone's thinking about, that as a category, either embeddable finance or banking as a service. Still an opportunity, not an opportunity, what to watch out for? What are you hearing? What are you watching for?
Yeah, I think it's still an opportunity because the market demand is there. And the experience that companies are able to craft, the enhanced customer experience, the cost savings, efficiency, some of the partnership opportunities are still available there that will continue to create an opportunity for banking as a service. I think what ends up being challenged is what you were talking about as far as the regulatory pressures there. And it seems like within banking and within insurance, the regulatory moats that are there are just larger than some companies had anticipated. And you see insurance a lot of insurtechs, it'd be a more challenging last year or two for them because of the regulatory pressure, and because of that moat, insurance companies have been able to catch up. And then some of the banking as a service companies, but also just the large fintech banks, it's been harder for them to establish themselves, get a license, and really compete with these other massive banks that have, cost of capital, regulatory advantage. How they overcome that, I think they'll be small, they've acquired very small banks, or very small insurance companies, been really thoughtful about the markets that they end up going into that are large markets where they can build businesses for insurance that may be large states, and for banks that may be certain segments of the population that are unbanked or underbanked, where it's relatively cheap to acquire them and they can have a good amount of margin. But we'll have to watch and see how that evolves, because I just don't think we've found the answer yet.
The challenge over the last year or two is that a lot of these companies have kind of twice the exposure to the fintech cycle. So they've got the exposure of being a company, a startup being built in fintech, and they also have the exposure of having end markets that are ultimately the other fintechs or consumer financial products. And so it's probably important to take a long-term view and to be able to see what these might look like coming out of the next part of the cycle. But we advised this company Galileo on its sale to SoFi, and that was an issuer processor, and we tend not to think of processing and payments as a type of embedded finance, but it is in a way, and this market is a lot more expansive than just banking as a service platforms. A lot of these can take a long time to build out, and a lot of what Galileo was doing for decades was working with relatively small customers that only became really big and really valuable once we saw the consumer fintech boom. And so as companies like Chime and SoFi got really big and started getting into millions of customers, then companies like Galileo were able to also become big. But it took a long time for that to happen.
And Brian, did you want to weigh in? There's a few more. Yes.
Yeah, maybe just, quickly, again, maybe looking at this, at least what I, kind of advise credit unions and banks about is, I really view embedded finance as being, potentially a huge disintermediary for the way banks and credit unions have historically delivered loans to their customers. And so it's been a huge area of focus for us to invest in technology that will enable those smaller financial institutions to gain access to some of these very large retailers or other point of sale solutions, because the days of a consumer going into a branch of a bank or credit union to talk to a loan officer, we all know those days are very few and far between. So I think that's a big area of opportunity for those financial institutions to partner with companies that will give them access, into, where the loans are going, which is really at that point of sale, closer to the point of purchase. And if they're not there, they're going to have a tough time, adapting over the next 10 years to kind of the new way that people both pay and borrow money.
Sure. And I'm going to flip it to the chat because a couple questions came up, and if you just joined a little bit later, feel free to drop any questions in the chat as we're having this chat. So one question from Lawrence is, are we seeing a market interest for RegTech? I would think the answer is yes, but I will let Adam. How do you feel about RegTech?
Yeah, I think we're seeing a huge interest. We actually talked to our investors a lot about that, because there's various processes that can be required on anti-money laundering or know your customer, or if that's kind of the avenue this is referring to, that remain highly manual and individual, and oftentimes really repetitive across, whatever you're doing. And there's hasn't been a great solution to come in and solve this. I think there's some interesting products from a workflow perspective that are at least digitizing that and trying to reduce the number of, duplicative actions that you're having to take to fulfill these. But I do wonder, and I haven't seen anything yet, what entrepreneurs are doing with larger data sets with greater access to information to be able to make this a much more streamlined process going forward. When I look at some areas like, merchant acquiring and payments, I think it's the 7th or 8th inning of that market. When I look at RegTech, I think it's a lot earlier on in that market's evolution. And so it's tough to say which way it'll go, but it makes me excited that there's going to be a lot of opportunities in the next 5 to 10 years that are hopefully going to do a lot of innovative things that are less going to be revenue opportunities for companies and more just huge cost saving opportunities, mostly in labor, I think.
RegTech is also, anyone building in that space is going to have to really be thoughtful about their go-to-market. It can be very hard to sell into a large bank or a GSIB. We just advised the company Adenza, which was acquired by NASDAQ. And actually, most of the large exchanges, think ICE, think CME, think LSEG, the London Stock Exchange. They've made some kind of acquisition in this space. Adenza was a very large one. But the core rationale, the commercial logic there is that an exchange like NASDAQ is very good at selling into GSIBs. And this is a sales force and a set of relationships that can also bring RegTech solutions in to sell to the very largest banks globally. And so that right now is a big part of the market, and probably not one that a new startup would want to take on immediately. You probably want to start somewhere else.
All right, next question from David Troop. I feel like we need the music. Da, 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 da. So there you go. Have CFPB actions had any impact how you view opportunities? And to what extent does regulation in general affect your investment decisions?
Yeah, I think for us, because we're part of a much larger organization, sort of the reputational risk and kind of trust that our parent has built among the banks and credit unions we serve, really investing in companies that take a very conservative approach to compliance with regulations is really critical, because the last thing we want is some investment that we've made be the subject of CFPB or other regulatory scrutiny. And I think as they become more active, it definitely is an area that we will dig deeper on when we're doing diligence on a company. I just got off a call right before this with the head of our legislative affairs, because there's some legislation about some of the banking regulators becoming more proactive around regulation of some fintech companies. And so something we keep an eye on. And I think for a lot of investors, it could have a cooling effect if some of these companies now become exposed to direct oversight by the CFPB or other regulatory bodies for that matter.
And the next question seems to go out to you as well. I don't know if are you reading the chat? I can read it out loud too. About the NUCA limit rates for credit unions to 17%. One of the attractions of buy now pay, maybe it's later, or BNPY, is that consumers have I think it's buy now pay later, is that consumers have a fixed payment per month, often lower rates, all than unsecured credit cards. Do you think legacy open-ended credit card issuers will shift their program focus to closed-in type loans with fixed terms and monthly payments?
I haven't seen it yet. I think when we, again, talk to a lot of the credit union CEOs that are subject, and these will be federally regulated credit unions that are subject to the NCOA interest rate limits, I think they're kind of looking at that industry, cautiously studying it. but we have not seen too many credit unions to date kind of jump in as a way to, if I'm reading the question right, to maybe structure investments to get around the interest rate cap. But, with the rising interest rates and cost of deposits going up, that has certainly created compression for those federal credit unions because they're not able to go above that statutory lending rate. So it probably is forcing some to think about things a bit more creatively.
And this next question opens up, it kind of peels back what you're talking about for the broader question. How do you assess risk on acquisition targets? Dan, Adam, I'd love to hear how you think about that, because that's certainly like very tricky balancing act. That's what that hand motion was. Adam or Dan, whoever wants to go first.
Yeah, well, I think buyers are very careful, particularly the seasoned, experienced buyers that have done a lot of deals and the ones that have done big deals. The way, I mean, there's a couple of things that we tend to see. One is just very intense diligence processes these days. This has expanded a lot just in my 10 or so years of doing this job. Companies are very good at analyzing startups and acquisition targets, and they spend a lot of money and a lot of intensity and a lot of energy in the diligence process. So there are very large teams, very experienced teams, and they're looking for anything, underperformance, regulatory risk, signs that a team is loose in their seats, anything like that. In terms of the performance of the company, if it's a private company or even a public company, usually what we see is that the two parties have a decent amount of familiarity with each other before they wind up pursuing an outright acquisition or even a large strategic investment. These are usually companies that are not meeting each other for the first time during a sales process or during any kind of an auction process. Usually the target has been on the radar of the acquirer for a long time. Maybe they have a partnership in place. Maybe it's a company that has been it's a company that the target, that the buyer has been trying to buy for a while. And so usually there's a lot of familiarity in that sense. And usually the buyer has the ability to track the company's performance over time. Sometimes in terms of the question about milestones, buyers will try to structure the deal in a way that is structured around milestones. So you hear about things like earnouts and bonuses that are only paid out if certain performance metrics are achieved. When we're advising targets and our clients, we usually try to avoid those just because they're very hard to structure. There's usually a lot of misaligned incentives. They're very hard to track over time. But there are ways to do that. It's just usually not the best way.
And from your perspective, how long is long from like, hi, I might buy you one day to, oh, I'm buying you.
Yeah. I mean, it can be years. Often we get familiar with a company, we start working with them and advising a company informally, and it might not be 1, 2, 3, it might be 5 or even 10 years before that company actually goes through an M&A process. And there can be a lot of reasons for that. One is that if a company is really crushing it, which a lot of times, particularly over the last decade, these companies have done really, really well, it's not the right decision to sell. They don't want to sell, and so they keep getting bigger and stronger and more valuable. And they also become more strategically valuable. So the buyers don't go away. Everyone's heard this expression, companies don't get sold, they get bought. And so there's the best way that a company can set itself up is to be in a position where a lot of people are trying to buy them, and you've got buyers that are looking at them over and over again over time. And so an M&A process itself, just to give folks a sense of timeframes, an M&A process can take several months to many months, and then going from a signed and announced deal to a closed deal itself can take many more months, maybe as long as a year. And so those processes themselves take a long time, and then the lead up to them can take years.
And Adam,
Agree with Daniel. I mean, my background before I got into my day job today, I practiced law for 14 years. So, this is an issue that's near and dear to my heart. But when, we're looking at acquisition targets, especially in regulated industries, I mean, we rely on outside experts to bring them in, and we'll have a law firm generate a 150-page due diligence report that's analyzing every component of legal risk. We'll have one of the big accounting firms, if it's a company that's in lending, analyzing the credit risk. So we have to leverage a lot of the outside experts, and then it's our job to kind of assess what's been identified in those reports, and then kind of weigh that into the purchase price that we're willing to pay. Sometimes it's building in the indemnifications and other protections, and then also as part of the integration of that company into our organization, to the extent risks are identified, developing kind of that remediation plan to mitigate that risk to an acceptable level, as soon as we reasonably can post closing.
And Adam, did you have any different wrinkle to all of this?
I'd say I agree with a lot of what they've said. I mean, the risk framework question is interesting because I'd say the risk level that I'd say buyers or investors are willing to accept, particularly once you get beyond the venture and seed stage, is probably lower than a lot of people would appreciate, in the sense that I spoke to an entrepreneur the other day that said, 90% of the time this works out great for you, and 10% of the time we go to zero. Well, we're not in the stage of investment where we're willing to accept that 10% go to zero risk. So we're really looking for businesses that have found good product market fit. And so when you ask the milestone question, for us, that's a minimum of 10 to 15 million in revenues on up, and growing at the time whenever we invest in those businesses. So it's at a different level when you think about that risk. As far as the diligences today, I tend to agree that we do what we can to be competitive, and that environment changes over time. I think back to the days of SoftBank, or when Tiger was doing a lot of investments, and we had to evolve to compete in an environment where those investors were sending massive checks, doing it quickly, doing it with limited diligence. Today, I think there is more openness to do more regular diligence periods of 30 to 60 days in growth financings, and maybe longer for the bigger deals that Daniel may be working on. And I think coming out of that will be a lot of the best investments during this period. I think there'll be a lot of better, some of the best investments made in 2024. The last part I'd say is just to agree that a lot of these relationships take years to develop. And the relationship's important because there's the saying, everybody's money's green. There's a lot of people like myself that are out there trying to invest in great businesses. And so you're competing against a lot of people that entrepreneurs think look alike. And so, one, building a relationship with them over a number of years, and then two, being able to demonstrate some level of expertise where that entrepreneur can say, I like this person, will be a great person to work with, and also they'll be able to provide some value to me that will help me grow my business, is really important.
Great. And I wanted to get into the thing that we've kind of alluded to, but haven't gotten fully into, is AI. I mean, we keep bringing up cost cutting as like, ooh, yes, that's a great thing for this year. And I know this is a very hyped area, and I know this is like an ill-defined area often. So I'm curious, we'll start with you, Dan, because this question originated from you. It's just like, what are some real use cases you're seeing of impact of AI in financial services? And also, how do you define AI in those examples? Or
Yeah, great. And I'm going to be eager to hear what Adam and Brian are seeing too, because there might be a couple of clicks earlier in terms of things that are being built. Most of what we see our clients using tends to be things that are more predictive analytics, what we might have just called big data a couple of years ago. And it's a little hard to tell from the outside whether it's been rebranded or whether there are cutting edge models or novel applications in play here. A lot of it is kind of right around where you would expect it. It's around underwriting, whether it's lending or insurance or fraud or even in the AML KYC area. I am super excited. I'm as excited as anyone else about where we're going to see more novel approaches and what we're seeing in generative AI. Where people are talking about it a lot is in customer service, process automation, certainly thinking about Copilot being used for a lot of to augment and enhance a lot of the manpower that exists across financial services. We actually have a pilot program at Catalyst where we've offered a kind of Copilot to our analysts, and some people are excited about it. Some people are a little bit more skeptical, but we're in the trenches kind of seeing what it looks like and what we can do there and what impact it's going to have on our business. And so I think the most important thing that we all have to remember is that AI is never going to get worse than it is today. We're only going to see better models, better applications, more areas for it to be leveraged. And that's exciting. I think it's going to touch every aspect of all of our jobs. It's just not entirely clear what it's going to be because so many of these are so early.
I like that thinking. Won't get worse. Like they always think of that Mr. Paperclip thing that some bankers like to reference from back in the day. But any
Clippy was great.
any findings from the test so far of co-piloting with the willing analysts, let's say?
Yeah, I think the analysts are figuring it out. I mean, the challenge for us is that a model that generates information that's 99% right still isn't quite good enough, even if it can speed up the job quite a bit. It also isn't great to have content that's being produced, which just seems generic or feels a little bit like it was written by a highly polished AI. But we'd rather get the stuff that's almost unvarnished and work on it as a group to make it really client specific rather than have something that feels like it was written by the internet. So I think we're still getting there, but people are excited that we're using it, and we certainly have. I would say at a firm like Catalyst, where we have about 80 bankers, about 20 of those are senior level MDs and partners, and then we've got about 40 analysts and associates. The analysts and associates are folks that are in their early to mid 20s, and they are absolutely clamoring for AI. I think if we didn't have some kind of a pilot program in place, it would almost become an HR question. It would become a question of why aren't we doing this? And folks like me would have to answer for it. And so I think that's driving some of it. And I think we're all curious, including myself, even if I will look at something extra carefully that was generated by AI. I think we're very curious as to what that's going to look like. And as I said, if it looks good today, it's going to look better tomorrow, and better in the future. So I think we'll keep watching it. And I just it's just early for actually putting it into the field.
Sure. Adam, Brian, Dan wants to know.
Yeah, no, I mean, I think Dan did an excellent job, summarizing things, Adam. Probably every investor deck that comes through today has at least a slide or two on AI, but the reality is probably 90% of those companies are not using AI. Maybe that's even higher. So I think kind of peeling back the onion and where kind of truth starts to diverge from reality is I think the question now, because I do think it is still early days, but to Dan's point, I mean, where we're seeing it really is around customer service. We're starting to see some companies in the fraud space that I think are leveraging AI in some unique ways, and others that are kind of experimenting but have not yet kind of put anything into action. But Adam, I'm not sure if you're seeing anything differently.
Well, I agree with you that you see, everybody's trying to frame things as AIs and marketing, and I think that I would probably do the same in their shoes. I would love to, candidly, I'd love to see more opportunities that are truly utilizing AI. I think there's different categories. So we actually made an investment in a company called Core AI that is providing a customer experience and messaging that's AI assisted, selling into large corporates. And I do think there's a good use case there where you can have improved chat and customer service experiences that are pretty interesting. So we're seeing some things, and that's one of the few things that we've seen that's probably more advanced and productized in a way that fits into the fintech arena where we're investing. We've looked at, for our own business, utilizing essentially a model where we could feed in all the data from all the SIMs and Excels and everything that we've received to have our own, model, because there's some analysis like customer retention analysis that we're running on a lot of companies. It would be great if we could have a model that would just spit this out, or filling out slides for our investor memos. Some of those are standard slides that could be filled out there. I think the stuff that's more words and writing actually has more of a use case now, because to Dan's earlier point, we don't want to be 99% right on the numbers. We want to be 100% right. So that still needs a little bit of work to go. I'd say, on framing it in a more positive light, because Mary, you mentioned, we talk about cost cutting. I want to think about it more positively. So I think in payments in particular, there's a good opportunity in fraud to analyze massive sets of data and really get really accurate on fraud. I mean, we've come a long way since, the foundations of e-commerce and PayPal, when there was just rampant fraud, to where we are today. But I think we could get almost all the way there by the huge amounts of data that we have and being able to train those algorithms even more on the fraud side. So I'm really interested there. And I think fraud, when you look at it, that's just a horrible thing to happen in any economy. So as much as we can reduce that, that's positive. And then I would think of broadly these solutions as allowing us to be more productive versus cost cutting. I'm hoping they allow us to review, many more investments, invest more capital, do it more quickly in a way that allows us to be more productive with the same or more people, rather than, reducing our workforce to accomplish the same thing.
Adam, I did ask that in a tainted way, probably.
No.
Probably because I'm a writer.
I think that's
you.
the way. I think that's the way people think about this stuff.
Yeah.
Maybe it's that I'm an optimist, just generally. But I just think that it'll lead to just everybody's lives being better more broadly. And I'm sure there are one or two people whose lives will be worse, but more broadly, most of our lives will be a lot better as these technologies continue to evolve.
Sure. No, I think it does open one up to more creative ideas too. I would say, from my limited experience using it, it's like, it doesn't structure things well. Dan, to your point, it does read like, oh, this is very clearly not a human writer at times, but that's just an aside. I know we're coming on time. There's a few more questions, but one I wanted to ask for the startups who are watching now or at a later time is just everyone's recommendations for new startups versus those that raise but need another round. Curious of how you break those two apart and what you'd offer to both of them. Brian, I know you mentioned you're focused more on early stage, so maybe that's the place to start.
Yeah, I mean, I think maybe to Adam's point, I think especially when they are earlier stage companies that are below the 5 or 10 million of revenue, I think it, trying to have traction, a unique idea, which is becoming increasingly difficult just because there are so many fintech companies that have been launched over the last 7 years. It's hard to come across companies with something that's new and fresh, that has a large addressable market that is going to be investable. I think also, one thing that really is being rewarded is, kind of that pathway to profitability that probably was not as important a few years ago. I mean, what we've seen, so many direct to consumer fintech companies have pivoted over the last 18 months to try to be more of either a B2B to C company or even in some cases going B2B, just because trying to grow a brand and acquire customers is extremely difficult. It's extremely expensive. And I think at least over the last 18 months, the capital hasn't been available for those companies to kind of continue to grow at all expense. So, for newer companies, definitely, really focus on, what does that pathway to profitability look like, and how can you demonstrate that?
Yeah, Brian is definitely going to be more well served to advise these companies as they're forming. I'd say the one thing that I'd probably point to that's come up over and over again over the past 10 years is just, all the companies go back to people. And so when you're starting a company and you're in the early stage, it's really thinking hard about, the first hires you want to make or who you want to found your business with. And I'd advise people to be patient, to wait for really the best people to fit there, because the difference between a really good person to work with is 10 or 100 times your ability to achieve. And so it's just being really disciplined and ruthless with yourself as you assess talent and who's going to work at your company.
Yeah, I would underscore that. I've heard investors tell me that they invested in something not really knowing what the company did as much as they just believe in the person. I mean, I don't know how great that is, but it does show.
No, but I absolutely agree with that. I think there's investments that we'll look at. I'm looking at one right now where we know the management team really well. They've been successful for us in the past. And, not every opportunity is perfect, but people here, I think, are really excited about the opportunity because we've just seen what this team can do over and over again with a variety of different ideas. And that just says a lot.
Yeah.
Yeah, I think it's a lot to that point. I mean, when you have kind of the proven entrepreneur that's on his or her third company with a lot of the same management team, that de-risks the investment. I know it's always a challenge for that first time founder to go out and raise that capital, and even it becomes harder to bet on the person when there's not the track record to accompany it. And so that's when we definitely need to dig much deeper. But I agree, it starts with the team that's building and leading the company first and foremost.
And I've been told we can go over a few minutes before we break up. We'll do both things. But I do want to ask about identity solutions. Are you seeing interest in firms with those kind of products?
Yeah, I mean, I can jump in here. The interest is there. It tends to be a little bit around the edges, and so and it tends to be most interesting and most explosive when it's around new types of companies being built. And so one area that is kind of surprising is that there was a need for background checks to be done quickly and accurately for gig workers, as all these gig economy companies really started to grow and hire at scale. I've always been a little surprised that products that I think are incredibly cool in terms of biometrics or and identifying someone based on their walking gait, stuff like that. These products have a place in the market, but they just haven't had as much of an impact as I might have expected. And these companies tend to do well, but they just haven't been at the same kind of explosive growth rate as some other companies. Well, one thing I was going to suggest looking for as you're investing in early and mid-stage startups is not just the product and how novel the idea is and the technology, but also the go-to-market and the sales and marketing process, because that's so important. And that's where I tend to see these companies that have exciting identity solutions struggle, is they have developed something that's incredibly cool, something that is often quite difficult for me to understand, but I kind of marvel at what they've been able to create. And yet selling these things into FIs is very challenging. And so it either takes a long time or they hit a wall at some point. And so A lot of excitement there, a lot of cool stuff being developed, but it's harder for me to think of really big companies that have been built in the space. And in terms of the M&A market that I've seen, it's been there, but it just hasn't been at the same level as most of the other subsectors I spend time in.
And Brian or Adam, weigh in on this, or weigh in on, final thoughts or feelings you want to tell the audience before we break out into smaller rooms.
I think on the specific question, it's not an area that we've made any investments in. I think to Daniel's point of seeing companies looking to do some really cool things. So we've been kind of monitoring them, but really seeing how they might be incorporated into a broader platform, whether it be a payments platform, digital banking, digital lending. So yeah, it's not an area that we've again kind of pulled the trigger on from an investment standpoint.
It might be explosive and surprising though when it does happen. I mean, Sam Altman has a startup in the space, WorldCoin, that a lot of people have had fun reading about. It's a wild idea. It's a little scary, but if it works, it could completely change how we think about digital identity.
We years ago made an investment in a company called ID.me that did pretty well along the way. I got to think how many years ago, maybe 2016. And then during the pandemic, it just took off like a rocket ship because it started to win all these government contracts and be used for distribution of benefits. And there were a lot of learning experiences that went along with that and growing so quickly. But it's been an interesting one. Other than that, I agree with Brian that I just haven't seen and Daniel that I haven't seen a ton of businesses in this space and haven't had a ton of experience there.
Well, cool. I think that I will thank you all for participating in this conversation.